almost like it was a never-ending fight. It was just there were breaks in it. What kept me in it is because I kept waiting for the other shoe to drop.
Hi, I'm Robert Maltbie. This is Maltbie's Minute on the Market, our October edition, as we grin and bear it through a very difficult market environment. The report, our MMI report, has just been released. We're titling it The Other Shoe, which feels like it's dropping as we speak. Our indicators support further downside and more bearishness. That's a choir of that right now, but that's what the data shows. A chart of the inverted yield curve, which we'll display, says it best. That is one of the strongest forward-leading indicators of a recession, and it's flashing loudly right now. The market reminds me of the saying, the financial version of beatings will stop when morale improves. A financial version being the volatility will recede when morale improves, and certainly we hope that could be the case. We have record the worst 6 months of the year, the first 6 months in the S&P 500 in over 50 years, and the worst bond market now after this current week's performance since 1949. So S&P down 23, and the AGG, the ETF that is the aggregate domestic bond index, down 20%. Nowhere to hide here. Unparalleled increases in the Fed discount rate is the culprit. Very, very violent, and more to come, unfortunately. Our indicators scoring at one of the lowest levels, very bearish, that we've seen ever since the crash, the recession, Great Recession. Market sentiment is actually the only positive because it's so negative. Volatility, the evidenced by the VIX, is way up, over 30%, headed towards 40. The put-to-call ratio also elevated at 1.25 to 1. Showing a lot of put buying, and also percent of stocks above the 20-day moving average, only 7%, showing a massive oversold market. Who knows when lightning will strike, but it'll be vicious when this thing bounces. Technical indicators negative. Long story short, as everyone's well aware, most moving averages below their overhead supply, 200-day, 50-day, and 20-day. Liquidity indicators are neutral. That's encouraging. There's a ton of cash on the sidelines, 4.6 trillion. So that produces some buying power when the green light flashes, whenever that is. Equity funds experienced 26 billion in outflows. New equity issuances all but dried up, so not much going on there except selling. Valuation has turned negative based on interest rates rising and earnings flattening out. We have the S&P still trading at an elevated level of about 18 times versus its historic average of 16.5. The market to replacement value negative at 1.4. The market cap to GDP also elevated at 150%. Earnings momentum negative. Growth estimates have receded for the third quarter significantly, and also in the fourth quarter significantly. And this is the next shoe possibly to drop. Monetary indicators negative. Are excess liquidity indicators comparing the yields of the S&P 500 to the corporate bond market is negative, evidenced by an inverted yield curve, well documented. The 2s are over 4, the 10s are below, and 90% of the time historically that results in a recession. So tough sledding. We urge clients again to observe the two age-old Wall Street adages: don't fight the Fed, don't fight the tape. Now on to our stock of the month. Firstly, our last segment's stock of the month in July. ARLP did very well. Alliance Resources traded up from 18-ish to 27 and achieved our price target very quickly, up 50%. We hope for good results, although we can't guarantee it will be that fast, with our new stock of the month, which is Kenai Holdings, which is a company led by Bill Foley, legendary fintech investor, innovator in mortgages, finance, has created multi-billion dollars in wealth in the public markets. And they're at it again. He's at it again with Kenai, lending his wisdom and expertise to drive this company's wealth and stock price higher. It is what we call a sum of the parts, and it's a holding company like a Berkshire Hathaway, a miniature Berkshire Hathaway. If you look at its liquid public portfolio, it is at a 30% premium to the stock price. That doesn't count Bill's expertise. That doesn't count the private equity holdings, which are estimated to add another 15-20%. So Kenai Holdings, 20 on the NYSE. We have a price target of 30. Okay, let's hope for the best. Keep those helmets on, seatbelts buckled, and that other shoe hopefully is dropping now. I'm Robert Maltbie. Join us and visit us at singularresearch.com and take advantage of our complimentary trial and get in front of some of our great research ideas in this environment. These companies are at epic, stunning valuations that will be proven over the next 1 to 2 years. Thank you very much, and better times ahead. Thank you.